Funny how it always seems to come back to the accountants. Of course, if this were a marketing course, we would be making them the stars. Before we talk about ratios, the topic for this week, there's a very important idea embedded in that discussion our boat company founders were having that I don't want you to miss. Any idea what it is? It's the absolute necessity of making sure the accounting and finance folks are given a seat at the table during all of your operating meetings that go on in your business. Whether you're a startup or a mature operation, it's absolutely critical that your controller or other finance leaders are brought in early to make sure that key operating decisions are made with a full understanding as to how they'll impact the financial reports. For every decision made in your business, the best managers know how to answer the question, if I do this, how will it make me look? What do I mean by that? I mean, you have to know how the transaction will get recorded and reported. Will it increase sales, impact net income, make our business look better or worse? Too often, you can run into situations like we see at New England Boat Company, where the folks on the front line are operating under one set of assumptions, only to find out that what they thought could be reported as a sale has to wait until next period. How do you prevent this from happening? Invite your controller to sit in on your sales and production meetings so they can see how you're structuring these key transactions. That way, you can ensure everyone is on the same page when it comes to how your most important decisions will get reported. And reporting means more than just what gets disclosed as sales or cost of goods sold. It's also about the relationships found in the financial statements that provide insight into the company's profit performance and financial position. These relationships can best be revealed through a careful ratio analysis, which is our focus for this week. While there are all kinds of ratios that can be computed from a firm's financials, I want to concentrate on about a dozen or so ratios that are the basis for any analysis of the financial statements. I'll break these ratios down into 4 groups, which correspond to the 4 different areas we typically investigate when evaluating a firm's financial health. First, we'll look at the income statement and profitability ratios. Then we'll move over to the balance sheet and analyze asset management ratios with a special emphasis on working capital analysis. The third group of ratios relate to evaluating return on investment, first from an overall perspective using return on assets, and then from the owner's perspective using return on equity. Finally, we'll look at ratios that give insight into the firm's liquidity and financial solvency. When we're done, you'll not only be able to conduct your own financial analysis, but you'll also see how different business models and strategies can have a big impact on the financial statements.